Hi, everybody. Do you trade gold? Well, it sure shines. And today we're going to dive a bit deeper into what moves gold. So, I hope you're all set. My name is Yohay Elam. I'm of FXStreet. I'm the author of the Orange Juice newsletter. So, I used to be a retail trader, a computer programmer. I founded Forex Crunch in 2008. It was acquired later on, and I've been with FXstreet since 2018. My focus is on fundamental analysis. As mentioned, subscribe to the Orange Juice newsletter. I also do public speaking, write whatever is needed. Okay, let's kick it off. We're going to talk about these topics. We're going to run them relatively quickly. We want to keep you all awake. We'll start with some myth breaking. Is gold a safe haven? Well, that's what it's considered, right? It was used in ancient times, including here where I'm based in Spain, as a form of a currency, as a store of value. It never erodes, despite attempts by alchemists in medieval times to change that. And during the 20th century, not that long ago, it was tied directly to currencies, the gold standard. Well, that had issues of its own, but it was considered a safe haven. The theory is, again, it has limited capacity and it serves as a hedge against inflation. That's the theory, a hedge against inflation. I don't agree. I see gold, like anything, the theory about it working until it doesn't work. It only works if everybody believes that gold is a safe haven. And of course, as traders, we want the trend to be our friend. So, is it a hedge against inflation? Not exactly. And is it a hedge against recessions? Well, it's mixed. It sometimes better, sometimes worse. These are the charts that show various types of behavior. What I can tell you is like this. Apart from making the trend your friend, gold is a safe haven only in specific situations. Okay? So let me say that once again. Stop sharing. Let me focus on the camera. So, gold is a safe haven only in very specific situations. When there's trouble in the Middle East, gold goes up, works as a safe haven. When there's just a bit of trouble in US stock markets, gold can go up. But when US stock markets totally crash, there's a sell everything phenomenon and gold falls as well. So it doesn't always work like that. What about inflation? Here I want to stress gold goes up when US yields go down. When do US yields go down? When inflation is falling and the Federal Reserve decides to lower interest rates. That's a reverse correlation with gold. So gold is not a safe haven against inflation. Okay, let's go back to the presentation. I want to share I have a few more things. I wanted to start with the most important thing, but now let's continue. So, gold and yields. For me, this is the best thing you can take from this presentation. As I said, gold goes up when yields go down. Why is that? Why does that happen? Well, if gold is seen as a safe haven, then it competes with something else that is safe. That is the benchmark US Treasury yields, preferably those 10-year yields. That's what any investment is compared against. If I want to invest in a factory or a startup, will I make more than I make on 10-year Treasury yields? The same goes for gold. The fact is, gold does not have a yield, so prices of gold need to go up faster than yields. Okay, here we can see the inverse correlation of gold against 10-year Treasury yields. We can see how one goes up, the other goes down, and it's yields that lead, gold that lags. Okay, so what about what we just had in the US? A government shutdown, the longest in history. And sometimes we also had debt ceiling debacles. Ooh, that means the US could maybe will not pay on its debt. Markets always think, well, that happened before, they always got a solution at the end. Nothing to see here. Usually there is no reaction. In gold, it doesn't make treasuries look less attractive. It doesn't help gold that much. That can change in the future. Any pattern can change, but this one has not changed at all. Sorry. Now, yields are correlated with gold. The more yields go up, the more gold goes down. And the other way around. The more yields go down, the more gold goes up. The reactions are best seen when they're strong. So if there's a sudden movement downwards in yields, for instance, if we get an inflation report showing inflation is down or a jobs report showing lots of unemployment, then we have a big swing in gold. Okay, when the other thing, other direction happens when we have high inflation, we think interest rates are going to go up, have a sharp rise in yields, then we see gold falling. But when there are very small moves in yields, 1 basis point, 2 basis points, 5 basis points. Usually the effect on gold is minimal or maybe invisible even. Okay. Um, but another more advanced topic here with yields, I want you to take away is that when gold rises with yields, that means when we do not have that correlation, that's an indicator. It shows us that gold is so strong that it ignores rising yields. And the same goes the other way around. When gold falls with yields, it means it's a sell everything situation. That is not helping. That means gold is weak. And what can we learn when we learn that? What can we do when we learn that gold is either strong or weak? It means now we're in a specific situation and we can take advantage of it for the next time. So if we discovered that gold is now strong, the next time there will be a small decline in yields, boom, gold will probably go up very sharply. And when we identify that gold is weak, the next time there's just a small rise in yields, we can expect a big sell-off. Okay, so once again, I want to say something to conclude this chapter. When gold rises with yields, which is not the normal thing, we identify gold as strong. We can use it for the next time to ride higher with gold. When gold falls with yields, we identify that gold is weak. So the next time, the short future, when there is some reason to sell gold, like rising yields, there will be a big fall. Okay? So, yeah. Now let's go back to the presentation and we'll talk about, for me, one of the biggest influences in recent times on gold. I'm talking about gold accumulation by two big countries, Russia and China. Russia, from the Cold War, and China, the world's number one economy. We'll start by China, the world's number two economy. Sorry, number one is the United States. So, the Chinese central bank is wary of the US trade war. It began with the first Trump term. Biden didn't undo any of the tariffs, and now the trade war in Trump's second term is much more intense. On the other hand, if China is wary of the US using the dollar as a weapon, maybe it should let its currency, the yuan, become a more global one. But China wants more control. It is unwilling to let the yuan float. In the meantime, they're just buying gold, accumulating, accumulating, accumulating. China is buying lots of gold all the time. Now, it's been very sharp during this year in 2025. And I would say also it comes at the expense of other activities. So if there are struggles in other areas of the economy, the Chinese government will do the minimum, but will continue to buy gold. Now, we do not get that much data on China's gold accumulation. You'll only know after the fact, and the data, nah, it's questionable. But we do know that they are buying and buying and buying. So for me, that buying of uh, gold by China is keeping the price up. Sure, there are ups and downs, sometimes big falls, but the trend is up thanks to this buying from China. Here's a beautiful chart of gold by China, which is rising more quickly in 2025. Let's move to Russia. Also here it began earlier. It began already in 2012 when prices of gold were tumbling down. It was around 1,100, 1,200. Yeah, something like 30%, 40% of current prices. In any case, in 2014, there was the first war with Ukraine, maybe long forgotten. and there were some Western sanctions that's when Russia began accumulating more gold. It's part of their attempts to have a fortress economy to make it more independent of Western sanctions. Sorry. And then, of course, came 2022, the current war with Ukraine. Hopefully, all wars will end. Anyway, Russia's central bank assets were seized by the West shortly after the war, and we can see Russia trying to sell some of its gold. I think it's a minor factor. Again, China is buying much more, and Russia is not selling that much gold. In any case, we want to know that both countries are trying to have more trade with India and that both countries are buying gold. Will this continue into 2026? I don't know. Prices are high. Maybe the Chinese authorities in Beijing will take advantage of the situation, sell some gold, do other kinds of stimulus. They're investing a lot in AI, green technology, you name it. But for now, it's a factor. Okay, and let's move on to other topics. I know if you're trading gold, you might be trading silver, you might be trading oil. So let's talk about silver. Here, there's something important to know. When the gold silver ratio hits extreme highs, it's usually time to buy silver. Okay? Again, when the gold silver ratio hits extreme highs, that's usually a bullish sign for silver. So you can look at gold, you can look at silver and trade silver, not gold. This is the this is the correlation with also with the US economic recessions. You cannot usually see the gold silver ratio shooting higher at the beginning of the recession and then falling back down. What about oil? So gold and oil are correlated only around geopolitics. Remember I mentioned the Middle East? Okay, I'll repeat that. When there's something bad going in the Middle East, let's say in June 2025, we had Israel attacking Iran. Very long story, I won't enter into politics, but there was a risk of oil outflows from the Persian Gulf to the rest of the world. And of course, gold, as I mentioned, is a safe haven when it relates to the Middle East, not in every situation. So gold and oil were correlated. Gold and oil both went up. When the war ended, after 12 days, fortunately, a short one, not a long one, both went down. Sorry. What about gold stocks? So it makes sense. A company mining gold benefits when prices go up and it loses when prices go down. But some companies, even Barrick, but also other ones, they don't mine only gold, they mine other stuff. So cobalt, palladium, silver, all those rare earths now that so many countries are into, these companies mine them as well, and stocks move in tandem with other metals as well. So yes, there is a correlation between, you can see lists of gold stocks if you chat GPT them or Google them. Their correlation with gold is strong, especially in sharper moves, but not always. Okay, now perhaps the most actionable part of this webinar, gold timing. So let's start with the seasons. Let's start with something anecdotal. The Indian wedding season. Dates, auspicious dates are used for weddings. Prices tend to rise before these dates because gold is a common gift in Indian weddings, and then the prices tend to fall. That's more of an anecdote. The effect is relatively minor. More important thing is to see the seasonal effect. Here we can see that October is the worst month for gold. Usually, you can say when the autumn leaves fall, that's when gold falls. And January is a great month for gold, for prices to go up. Yes, those of you trading stocks might have noted that there is a correlation here with stocks. Again, so gold again is not a haven. And yeah, what about days of the week? So gold has a U-shaped week. What does it mean? It means that it begins at a relatively high point, then falls in the middle of the week, finds a low on Tuesday or on Wednesday, and then begins rising again towards the end of the week. Does it happen every week? No, but it's a pattern that repeats itself more often than not. And what about specific hours? So, big moves happen around economic events, like other things, especially US releases, non-farm payrolls, CPI, Fed decisions. These are the most impactful events. In that sense, gold is very similar to other currencies. A release can trigger action also regardless of the data. So you can see that prices are super stable, moving just nervously, but within a very small range. And then data can come out exactly as expected, no problem. Gold still moves because everything moves, because people, investors who had planned buying or selling, they were waiting to see if the data didn't change their mind, and then they acted anyway. So even if you're a technical trader, even if you don't trade um, according to fundamentals, you should at least know when the data comes out. And another thing to know is that there's lots of action around the openings. So need to be aware of when Tokyo opens around midnight GMT, London around 7 GMT, and New York around 12 GMT. It changes according to summertime and things like that. So verify, and there's action a bit before the opening and around an hour afterwards. Then further away from these openings, in between there's a valley, there's less volatility, and then around another peak in volatility when there's the around the open, and then another valley. Happens every day. Okay, before we get into before we finish this, I want to just sum up this chapter, I think, which is very important. Sorry for my coughing. So, what you need to know, season-wise, gold falls with autumn leaves, especially October, terrible month for gold. We've seen that also this year in 2025. The big fall was in October. Big rise in January, just like stocks. Weeks of the days of the week, sorry. Days of the week, gold starts high, falls in the middle of the week, then rises once again. So it's a U-shaped week. Happens more often than not. And you need to be aware of when economic releases are expected, especially US ones, those released at 8:30 Eastern Time. And these have a lot of impact, even if they come out exactly as expected. You also need to be aware of openings. London, Tokyo, London, and New York. Around these openings, there's just more action. Okay, and uh, take a look, even if it's anecdotal, on Indian wedding days. Auspicious dates tend to see a bit of gold buying beforehand and a bit of gold selling afterwards. Okay, so that has been my webinar about gold. As usual, you're welcome to visit FXStreet, sign up to the Orange Juice newsletter. We had a mini series about gold where you can read everything more in detail. You're always welcome to ask me questions, and you're always welcome to suggest topics for the newsletter. Newsletter includes the Big Orange, the main theme of the day. It includes the a part about the citrus report where we dive into more deeper topics in depth. Also, each day we have a different section and a few key calendar events, a few zesty market moves, a few links, a funny meme. These are all small things. We want to keep you entertained. We want to keep you busy, but not to waste your time. One main theme, one in-depth topic. All the rest is that's what you need to know. Actionable, to the point, as always. So, thank you very much. Sign up to Orange Juice. This has been a webinar by FXTrade by me, Yohay Elam. See you soon.